Hi, everyone. Thank you so much for joining us to increase your knowledge about the world around you and how we all together, especially our Memphis community, are going to come out of this particular situation we're in better off. The Chamber is really focused on providing every business person in this community with the best information possible, timely information to help you grow and build your companies and your own reputation. So twice a week, we're going to be doing these lunch in the nose, and we're digging into some of the best content providers possible. And I hope you share these links going forward. So every Tuesday and Thursday, come back for more. We're going to run these in 45-minute segments because it's so important that we go fast and let you get on with your day. But of course, none of this would be possible without our great sponsor. So I'm Brian Stevens. I'm on the board of the Chamber and the chair of the Small Business Council. And the Chamber is certainly wants to provide you this great content, but without sponsors like Independent Bank and Susan Stevenson, we wouldn't be able to do it at all. So I'd like to introduce Susan Stevenson, who is doing so much for the community. And she's so busy right now with all these care loans and all these other products that we're all looking at to try to protect our businesses, that I'm really thankful she had the opportunity and the time to come on today. So if I could get Susan to come on and say a few words before we get to our presentation, that would be great.
Hello, I'm so glad to be with you today. And I want to say thank you to, first of all, to Brian. Thank you for introducing this opportunity to everyone in the community. I want to say thank you to the Chamber. Everybody knows this, but the Chamber has been working whatever is the equivalent of triple overtime to try to make sure that we all have the best information possible. And they have been an invaluable resource to all of us in the community. And I want to give a shout out to small businesses. This is something that we're passionate about at Independent Bank. We are entrepreneurs ourselves, and we understand how hard everyone's working to make their business thrive in these extraordinary times. It is a really great privilege to be a part of the Small Business Council, because we understand that small business is the beating heart of our community, and we appreciate everything that everyone is doing. And we are so grateful for the opportunity to get smarter and better in this process. I want to say a special thank you to Waddell and Associates and to David. Your team has been helping make through technology and through lending us your resources, you've been helping make this all possible. So we are very grateful, and we want to say thank you. We look forward to joining everybody and getting smarter. I think this approach of having the Zoom technology has made it possible for lots more of us to participate. So thank you. And to all of you in the small business community, we're here to help. We have processed all of our loans. Everyone who applied for a PPP loan through our bank got their loan. And we're very proud of that. That took a lot of work on our part, but we want to make sure that we're here if there's a second round. So let us know if you need our help. And thank you again for all you're doing for our community. And now I turn it back over to Brian.
Thanks, Susan. And once again, we're all still trying to play around with this technology and learn how best to present to you information. So, please apologize for any little gifts or issues going on right now. I mean, I just had an issue. We practiced this at 11:30, and when we went live, all my notes on my screen just disappeared. So luckily, I've got most of it memorized, so I'll try not to be too discombobulated when we go. A couple things to know. One, if you have questions about these presentations, you'll see a little Q&A button. It's at the bottom center of mine. If you click on that, we're going to save all the questions to the end, but I'm going to be looking at those. Hopefully we have some time to get to those. If we can't get to them all, I've talked to David and Teresa, and they're willing to maybe bake in some of this in their weekly e-blast. And so we'll talk a little bit about that at the end, but if you want to have questions, I'm going to ask Teresa to really give out their email address so you can get on their weekly email that I read pretty religiously. So you can get this content week after week from them. They provide a really great weekly summary of what's going on. So if you do have a question, hit that Q&A. We are going to move real quick through all these. We're going to let them go first, and then we'll take questions at the end. Not every one of these webinars will be done exactly like that, but I think that's a framework that the Chamber wants to roll out to you. So thanks to Susan and thanks to the Chamber for getting this together. So our topic today, I got David and Teresa of Waddell and Associates I could give a really long intro, and I know that David just wants to get to what he wants to get to. He's religious about winning. And so we're going to turn it over to them pretty quickly. But I would say this. I know that everything they say is going to be really useful, and we're going to be talking about what the coming economy is going to be. So we're going to get right to that. So I'm going to go on mute. If you have questions, hit that Q&A box, and I'll be monitoring those. And we'll turn it right over to David and Teresa with Waddell and Associates. Thank you so much.
So thank you both for that intro, and thank you to the Chamber for facilitating this discussion today. So what I'm going to do is walk you through a macro assessment of where we are, try and cut through the fog for you to give you something to hold on to. There's a lot of content out there. It's a question of how to prioritize it, focus on what's most important. Then I'm going to turn it over to Teresa Bailey, who is our Director of Development and a wealth strategist, works with a lot of entrepreneurs, works with a lot of business owners, and she'll give you some actionable things that you could do as you prepare for what should be a much better second half. And with that, I'm going to go ahead and kick it off. That's the disclaimer. You read it. All right. We had a forecast coming into 2020, really predicting that we'd probably see 2% GDP growth. We'd probably get about 2% interest rates, 2% inflation. That'd be a pretty benign environment, which could be good for equities and good for business. That was going swimmingly until this guy showed up. And so now we are dealing with a pandemic and trying to adjust quickly to this new reality. Well, it's not really new. We've had pandemics in the past. There have been 4 notable ones that you've probably read about at some point in time. Back in the 1920s, we dealt with not only World War I, but concurrently the Spanish flu. And what I'm showing here on this chart is the amount of fatalities on the left-hand side. And the reason why you see a dotted line at the top of that chart is because overall, globally, there were 50 million fatalities, and that doesn't fit on that chart. And so there was no antidote, there were no treatments. It was a very difficult time. Fast forward, we had another pandemic of size that hit us in 1957 and 1958. In the history books, that's known as the Asian flu. We're going to spend some time on that. And then we had sort of an echo flu that followed that, was particularly devastating in Hong Kong, but swept us in the US into foul trouble as well. And so 1968, we had a big one. And then we had the swine flu, which nobody remembers because we were coming out of the great financial crisis, but it was particularly infectious. It didn't kill a lot of people, 325,000 total across the planet, and about 13,000, I think, in the United States. But there are pictures on the internet of Obama getting inoculated, et cetera. So we've dealt with flus in the past. The question is, which does this flu most closely resemble? And after all the work I've done, I think this flu most closely resembles what we saw back in 57 and 58 with the Asian flu. And here's why. We had those 4 pandemics, but only one of them also accompanied a recession and a bear market in the US stock market. Additionally, during this period, you did have lockdowns, you did have quarantines, there were schools that closed. It was not a national implementation of those policies, it was a local implementation. Nonetheless, by the end of it, there were 3 billion people on the planet at the time, 625,000 cases led to 1 million deaths. And there were 65 million cases in the US. That's with our population half this size. We had 116,000 deaths. So it's a proper analog, I think, to where we are. What I'm showing you in the chart is the number of deaths over and above what we typically would have seen during that time period. So it did come in waves, but you can see by the end of, or the middle of the spring of 1958, it had passed us by. All right, here was the impact of that on the stock market and the economy. Again, the flu was in the system, if you will, between February of 1957 and September of 1958. During that time, the max drawdown on the stock market was 18.3%. So it certainly qualified as a bear market when you take out the dividends. If you look at the total return over the entire infectious period, it was actually positive by 20%, which is encouraging. Now let's talk about what happened within the economy. And I spent a lot of time on the Fed's website going back and trying to get a sense of this. What you see is that we went into, by the third quarter of 1957, the economy was doing fine, growing at a 4% annualized rate. And then we went into quarantine, isolation, and dealt with those escalation and fatalities. And so we actually shrank in the first quarter of 1958 in the economy by 10% at an annualized rate. That's a big number. And the consumer spending during that period also turned negative, which it's only done 4 times quarterly, going back to the Great Depression. So it was a significant drawdown in economic activity. But then look what happened, right? We actually did get a vaccine during that period, which, by the way, was only 60% effective. But it got into the system, it restored confidence, and the economy really boomed coming out of that. 9.3, 9.4, 7.7. So if I just track sort of the course of the disease from February of 57 to September of 58, the economy actually grew 6% over that entire time period, or 2.7, and then if you extend it out, you get to 6%. The GDP drawdown was again at its worst, 10% in that first quarter of 58, 3% annualized if you like those figures that way. Let's bring all this current. So the Dow, from top to bottom, fell at its fastest rate in history and shed 38 percentage points. And right now we're down 600 today. We're just in a trading range. We have now retraced 50% of that decline, and we're sort of flatlining there. But the total return over the entire time period is down 20%. So as you know, we hit a low, we bounced back. Looks very similar to what we saw in 57, 58. Here's where GDP growth projections are, and I'm picking on Morgan Stanley here just because I thought their numbers were reasonable. So we had good economic growth in the fourth quarter of 2019. We haven't gotten first quarter growth numbers yet, but they're likely to be negative. January was good, February was good, March was terrible as we all went into isolation. And then we roll into the second quarter where, of course, there's going to be a huge divot in economic activity. The estimates right now range from -10 to -50. And so just picking a midpoint, I think, -30% quarter over quarter probably makes sense. And that sounds horrible. And most headlines stop there. But here's the news. They also forecast that in the following quarter, things come online pretty quickly. Most of the damage done, if I survey our client base, has been done in restaurants and retail, entertainment venues, et cetera. These are luxury goods in the way economists look at things. They can come offline pretty quickly. They can come online pretty quickly. So we're not dealing with big structural issues where we've shut down factories everywhere. Most of our manufacturing clients are still producing, and some more than they were prior. And so it's really a consumer discretionary spend kind of crisis. That can spool up pretty quickly. And so if you look at the numbers, the 30% quarterly drawdown will annualize out to about 8%. So we'll be down 8% in terms of total capacity in the US economy annualized. If you fast forward, things come back online, we actually grow 3% if you do kind of an 8-quarter time period. So this is encouraging. I hope to all of you, it's going to be a nasty quarter, but I think we're already sort of through it. All right, in terms of the recession being priced into the stock market, absolutely. So these are returns in the S&P going back to 1928. And you can see on average, we've dropped 34% during recessionary periods. We accomplished that, down 38%. So the question then becomes, is this something worse? Is this 2007? Is this 1929? I don't think so. I think this is an event-driven drawdown. I don't think the economy was either a victim of structural imbalances, meaning I don't think that Susan lent too much money and people borrowed too much money. I think overall credit was fine. We also didn't have any big policy mistakes. So there weren't any structural issues in the economy. From a cyclical standpoint, things were actually accelerating into the moment the coronavirus hit. So we weren't winding down. The Fed wasn't tightening rates. We weren't worried about inflation. So we weren't really at a moment when the economy should roll over cyclically. So it wasn't a structural interruption. It wasn't a cyclical interruption. It was an event-driven interruption, okay? Now, event-driven interruptions could be pretty sharp drawdowns. And so we had one in 98 with the Russian currency crisis. We had one in 87 when all of the machines went haywire. We had one in 2001 when we had the issues with the World Trade Center. And so event-driven drawdowns can come and create havoc, but they also recover much faster than the other sources of disruption. So on average, it takes about 5 years for markets to recover during recessionary-like periods. If it's structural problems, a la 2008, it can take a whole lot longer. If it's cyclical, a la 1990, 1991, Fed just puts the economy in recession to avoid inflation. It can take a while for that to recover. Event-driven bear markets typically last less than 2 years. And I think that's the kind of market that we're in. There are three things that we have to inoculate to keep this from turning into either a structural problem or not even cyclical, just structural. First thing we've got to inoculate against is a financial crisis, okay? We were in one in 2008. This is something we don't want to repeat. The Fed learned a whole lot during that time period. I will state, Susan, you can agree or disagree, that the Fed has done yeoman's work to support the banking system. We cut interest rates to zero. They did that almost immediately. And they have activated their emergency QE program to a tune of, it could be, $6 trillion by the time we're all done with it. And so they've done everything they can to shore up the financial system. And although there have been some discrepancies and spreads across financial markets, nothing too big. And so I would say overall that we have successfully inoculated against this crisis. We are not going to have a banking and financial crisis. What about the economic crisis? Well, I offer this slide to give you perspective of decisions being made today versus decisions that were made back in 2008, 2009. So at the bottom of the chart is how many days since an event occurred. And let's talk about the great financial crisis. The event officially occurred in August of 2007 when 3 hedge funds inside BNP Paribas blew up. And then it cascaded and rolled through the financial markets. And there were stimulus measures that were deployed, but they were deployed somewhat reluctantly. And I would also say at a pace that was behind the curve. And so you can see we didn't get the first stimulus bill until 200 days after that hedge fund implosion. And then, another 400 days later, 2 years into the financial crisis, we finally got from Obama the American Recovery and Reinvestment Act. So it took 2 years for this stimulus to come out. Let's fast forward to today. Since China reported the first death from coronavirus on January 11th, 2020, the government has thrown out almost $2.5 trillion. And watching, I don't think they've approved the next tranche of 500 billion, but they're about to. So the government has rolled out more stimulus over the last 20 days than they did over the 400 days, post 200 days after the implosion of those hedge funds at BNP Paribas. And so this is an enormous amount of stimulus. And I will tell you to size it in your head this way. The US economy is $20 trillion, more or less, okay? So if the government's gonna pump in $2 trillion, they just bought you 10% of the US economy, right? $3 trillion is 15%. So at this point, I think the economic drawdown is gonna be 7-8%. The government's thrown 15% stimulus at that. We are not going to have an economic crisis. Now, that's above the waterline. Below the waterline, businesses are in disarray and there's a whole lot of reorganization, and Teresa's gonna touch upon that. But I don't believe that ultimately we're going to have an economic crisis because of the power of these programs. The third and most important crisis that we've got to inoculate ourselves against is the healthcare crisis. Now, I'm going to do some numbers because early on I had to frame what I thought the size of this thing was going to be. I am no doctor, just a guy who gets paid to predict the future and hope it works out. If you're right more than you're wrong, you win. As Brian says, I like to win. All right, typical flu season. All right, there's 7.7 billion people. The infection rate runs about 10%. So 700 million people annually catch the flu. Of those, about 650,000 will die. In the US, you've seen these numbers probably. US cases range between 40 million and kind of 50 million. So on average, let's say 40 million catch the flu. Fatalities on average are 40,000 people just for flu-related issues, mostly respiratory. Puts the US fatality rate at about 0.1%. That's normal. Here's what I pulled 2 days ago. So right now there are 2.3 million cases that have been reported worldwide. Remember, that number is going to go way above that and will only appear in estimates once this is all completed. Current fatalities worldwide are now 170 and change thousand. US cases, we've seen about 755. US fatalities, 40,000 cases. So we've gotten to the point of typical flu. Now, some of the diagnoses, some could be flu, some could be COVID, or kind of commingled. And that puts us at this fatality rate that's terrifying at 5.3%. That fatality rate is going to come down dramatically, right? There will be an identification of people who have already had it. I think maybe I already had it, actually. And as those case counts come up, that fatality rate will come down. So here's my estimate. Using the Asian flu as a guideline, because you got to pick something. And let's say there's a 15% contraction rate across the planet. 1 billion people get this thing. How many will die? 2 million. That's in line with what we saw back in '57, which was 1 million. The global population was half the size. In terms of US cases, again, during normal flu season, we run between 8 and 11% infectious rates or contraction rates. And so let's pick 12 and say lots of us get this if we haven't already. And you've seen these number banded around, but I'm just using the 0.18% that was consistent with what we saw back in '57, '58. So 70,000 people will die. Obviously, that's terrible. And so how do you offset those numbers? Well, you go into quarantine. We've been good at that. The social isolation has definitely worked, and we can see it now in the numbers. Then for people who have it, you got to treat them. Market rallied hard on Friday based upon a release that Gilead's remdesivir drug was being utilized effectively. Estimate for that, these are my numbers, coming on market maybe 2 to 6 months. In terms of a vaccine, Moderna is probably in the lead there, but there are 70 vaccines currently being tested. And so we may see that within 12 months. That would be great. Your healthcare team is being effective. I pulled this off the web last night, I think. And so this is daily new confirmed deaths, which is really all that matters. And you can see the curves are rolling over. They seem to have peaked on April 16th. You're seeing some uptick in Asia, but that's just because they're getting the test kits, et cetera. But you can see in the United States, the European Union, and by the way, the EU has led us. What's interesting about that is Germany's basically opened up its economy. So there are some test cases for us to see what the impact of opening the economy will be in a world where coronavirus is still present. So here's a projected timeline that I stole from Morgan Stanley, but I think is probably right in terms of reopening the economy. So here's where we are. We have probably reached the new case peak already. And so we're on the other side of that. The antiviral trial results, which is the remdesivir, really should be released pretty soon. They estimate maybe April. Testing capacity gets to 1 million a day, maybe at the end of May. That's useful because then you can know coming and going who's got it or who had it. That's what we'll learn in June. So in June should be widespread. If you've had it, the assumption is you have immunity. That should be good. And then probably full-scale opening back to the employer goes to June, and then maybe a second wave going to work midsummer. Schools should reopen in the fall. Not quite sure what that structure looks like, but they've reopened in China. Maybe there's a potential second wave of infections, but a vaccine probably is available again by the end of the year, early next year. So that's all very promising. What that is going to do is take off the table the structural economic depression talk that is infecting my Twitter feed right now. So based upon the fact that I think we've inoculated the financial crisis, we've inoculated the economic crisis, and we're on our way to inoculating the healthcare crisis, this is the drawdown path that we could see within the economy. Now, The most optimistic of folks, and I tend to be optimistic by nature, think, okay, we'll fall 7-8%, but then we'll be back in business first quarter next year. The U-shaped scenario that you hear about says, yeah, I believe you're 7-8%, but I just think things are going to come online more slowly. Okay, so that puts us out, 10 quarters. We're already, 1 in. So a slow recovery rather than a fast recovery. But for those of you who think that any of this is depression-like, there's what it looked like in the Great Depression. You had economic drawdown that lasted 30 quarters, and at its nadir had pulled 60 or 43% out of the economy as a whole. So pretty nasty period. That is not where we are. All right, so here's the bottom line. And then I'll transition to Teresa for useful information. The 1957 Asian flu is our best proxy. 1 million people lost their lives. There was a bear market. The Dow pulled down 21%. The 18% I referred to earlier had dividends included. In terms of the recession, we had one. It was a hard stop recession. It was a doozy, and it was a 10% drawdown in the first quarter of 1958. The market bottomed, and this is most important, in the fourth quarter of 1957 in advance, which it does. All right, so here we are, coronavirus. We have twice as many people on the planet today as we did then. So let's say we lose 2 million souls. In terms of the bear market, we've already seen the market pull down 38%. There will be a hard stop recession in the second quarter of 2020. We're in the middle of that now. Question is, did the market bottom in first quarter of 2020? For now, the answer is yes. All right. So the financial crisis, we have inoculated against this. I feel quite confident that the Fed, which has done amazing work, will keep us from having another great financial crisis. The economic crisis, I can't give us a check there. We're not all clear because the health crisis is still with us. I will say that the amount of stimulus the government has allocated is certainly adequate to fill the divot. And then in terms of the health crisis, things are getting better. I think we're at the second half of this. Testing is coming online, which is great, but we're still missing a proven antiviral, and we're still missing a vaccine. Both of those things will obviously be necessary to complete the cycle. In terms of whether it's a V, whether it's a U, whether it's an L, whether it's a W, let me explain something. The market only moves in V's, right? And so going back to 1957, US stocks, large ones were down 11%, small ones were down 50%. Look at 1958. We were up 43% large stocks. We were up 65% small stocks. Here's where we are year to date. It was obviously worse on March 24th when we bottomed, but currently we're down about 11% in large stocks. We're down 30% in small stocks. What will next year look like? That is to be determined, but things are a whole lot better than they were only a month ago. So my final message from this presentation is that we have, in my judgment, reached the halfway point. Financial crisis off the table. Economic crisis, we've certainly inoculated, still has to play out because we got the health crisis afoot, but we've got 70 drugs in trials for vaccines. We got lots of antivirals. We got every scientist on the planet working on this. And we've seen the case count roll over. We've seen the death count roll over. And in Tennessee, we're going to open the rural economy May 1st. Information for the rest of us in the metro economies pending. So with that, I will get out of the way and give it to Teresa to talk more specifically about what you as individuals and business owners should be doing.
Thank you, David. Let me get your screen from you. All right, there I am. Hopefully everybody can see and hear me now. Thank you so much, David, for rolling through that. You had the much more difficult part than me. I get to talk about things we can control, where David had to dig through and dig through all the things we cannot currently control. So let's start to talk about how you can take control and shape your recovery in the second half. And definitely the first thing that I need to do, in addition to thanking Lainey Oberg for helping with this webinar, is give thanks to all of our Waddell and Associates Wealth Strategists. The material that I'm about to present to you is really a function of us coming together and strategically thinking about what opportunity this crisis has brought to our financial planning world. We, of course, first have to tackle the problems, and then we begin to look to opportunities. So very thankful for the strategists on my team, David included, and you may in Memphis be familiar with many of the faces on this screen. So the first thing you can do to begin to shape your recovery in the second half is take a look at your financial team, those that helped you through troubleshooting through all of this. You had your bank and your business lender, your CPA, your tax preparer, employee benefits, payroll, HR, and hopefully you had a wealth strategist or a financial planner who could help you through all of this. But it really comes down to, when you look at your financial team, who is in charge of the details, right? So your banker could have given you great advice. Your payroll person on your team, also great advice. But the person coordinating the details is often the one who takes the heaviest load right now. If you do have a financial planner or wealth strategist, they can often take that load from you. Now is also a great time to see, did everyone work well together? If it wasn't a fluid team, it's a good time to make changes, especially to help shape that second half for you. One of the things our team did at the end of every day during this period, we came together at the end of the day and we shared what we had learned. And the fruit of those meetings was the development of these 2 PDF files, which you can go and download. I'll get to that in a minute, in front of you, which is our COVID-19 financial prescription for both businesses and individuals. And if you go to our website, there'll be a pop-up for our coronavirus portal, and these documents are available there. I'll dig into as much as I can, given the time today at the end of the presentation, a bit from these documents, but it's a great guideline on some of the strategies you can begin to think about, both in your business and your investment portfolio and your entire balance sheet, to really reposition you for the second half of the year. All right, so in our conversations among wealth strategists, and again, when you hire one of us, you're hiring all of us. We really, especially right now, work as a team. We realized first step is to go back to the basics. With a lot of business and individual clients, it's look at that emergency fund. Was it really enough? There's always the general rule of thumb, and that's 3 to 6 months of living expenses. And for business, it's 3 months to 1 year of retained earnings for either an emergency or an opportunity. But in a time like this, where everything just turned right upside down and it became a sort of surreality, things that maybe you didn't or couldn't anticipate were happening. Was your emergency fund enough for a true emergency? You need to consider all of the possibilities. I'm stealing this one from David Waddell. He likes to talk about possibilities. Anything is possible. You really need to sort of group those together in one giant bowl, but then pick out the things and narrow down to what is likely a probability if something happens. Plan for those, do the math, and then consider adding a little extra sleep at night cash. I know Brian Stevens on a recent webinar said, don't go with your gut. On this one, sometimes you need a little bit of gut just to help you sleep through the night, which is important right now. And make those changes now. Do not wait until you catch up on cash flow. If you need to escrow monthly into an emergency fund, do it today. Make that change right now. Pay your future self just like you pay any other bill. On the expenses, mandatory versus discretionary. Remember, discretionary should be able to be moved and shaved off if necessary. So 2 things here. Were they easy to identify, and were you able to act quickly? So on the identification side, did you have in place the proper record keeping, either software or people? And do you have a disciplined review process? Were you able to act quickly? Were there any barriers to making the changes that you needed to make? This one's interesting, either structural or perhaps behavioral. Did you know that you needed to make a change, and for whatever reason, you just didn't do it? I'll go ahead and bust myself out here. I needed to cut back expenses. I may have a few more boxes showing up at my doorstep than I need to right now. Legal documents. This is a big one, and I found that it was one that everybody on the back end of it, I had conversations and everybody was thinking about it. They weren't yet ready to talk about it. Did you have legal documents in place for people to have access to and coordinate your business and health affairs if you ended up being one of the ones in the ICU. And this is very important. Now is the time to recognize that you did not have those in place or they need to be updated because of a family change, and go ahead and make the appointment. Estate planning attorneys and business attorneys are doing Zoom appointments right and left. These are the moments where it's urgent enough. If you wait, you'll kick the can, and in a future emergency, you might find yourself in the same spot. And I'll leave the legal documents on this note. Where are they? If they are at the lockbox in the bank, and the bank is drive-through only right now, you could find yourself in a pickle. So make sure you know exactly where the documents are, they're accessible, and that there are digital copies as well. I will run through insurance very quickly. It's always important to know the details of your coverage. We all have heard by now that Wimbledon had pandemic insurance, 141 million will pay out. I'm sure they paid those premiums year after year. I'm sure they were expensive and they groaned, but they continued to do it. And now they're a winner. The restaurant industry is having to go after some of their insurance carriers about business disruption insurance. So both know what your insurance covers and be ready to be an advocate for yourself if you find yourself in a situation like this one. All right, so beyond the basics, we'll get down into the COVID-19 financial prescriptions now. If you want to take out your cell phone and text, just like it's a phone number, Memphis Chamber to 44222. That will opt you into our weekly emails as well as any updates to this specific presentation. Again, text just like a phone number, 44222, and the phrase Memphis Chamber to opt your email address in. Quick comparison, everybody's, I think, familiar with PPP versus EIDL now. Since we're running out of time, I'm gonna scoot this next guy in here, the MSNLF. I haven't shortened it yet, so we'll just call it the mid-size loan. So this is the Main Street New Loan Facility. Quick details on this one. It's really on the guidelines that they've released. They're paying special attention to these funds not going to pay off other debt. You cannot use it to refinance other debt. And you must make effort to maintain payroll and employees. And when I say mid-sized business, it's up to 10,000 employees. That's generally what this loan is aimed at. All right, so it's loan size of 1 million to 25 million. The rate is adjustable, and it's based on the Secured Overnight Financing Rate, SOFR. I am not yet an expert on this rate, but I plan to be soon, plus 250 to 400 basis points. The term is 4 years, and 0% of this loan is forgivable. All right, and on to the PPP. We all know now there are some PPP problems. One of them is the 8-week covered period. And I think by and far, when I talk to the strategist at the end of the day, this is the thing that's coming up right now. We went through how to get your application, what documents were required. Now the money's come in. And hopefully, if you got your PPP money, you segregated it into a brand new account that will only handle PPP money. If you haven't, do that now. All right, so you receive your funds and you have an 8-week covered period. We now know funds eligible for forgiveness must be from costs incurred and payments made within the 8-week covered period after you receive the loan proceeds. And of those costs, 75% must be payroll costs to be forgiven and 25% non-payroll costs. That's your interest on loans and your rent, only 25% to that. So what if your business, and I just picked random dates, what if your business is closed until May 18th, right? You received your funds on the 20th, your end of covered period is June 15th. What if you're not open? All right, you need a PPP strategy. So 0% revenue before May 18th, 50% revenue after May 18th. So business gets back to working, you're not yet up to where you were, you're 50% there. What is that gonna look like and what should you do? All right, so before the business reopens on May 18th, you're gonna start to hire your workforce back. You're gonna stabilize that workforce and your PPP proceeds will pay for that. Through business reopening, you're gonna be at that 50% revenue. You have your workforce back, PPP will pay for that. You reach your end of covered period, those payroll costs plus 25% non-payroll will go into your application and will be forgiven. The net result of that is some of your PPP funds may turn into a loan. Instead of forgiveness, it's really favorable financing. It's 1% for 2 years. So I think we have a lot of folks who are trying to run the benefits and maximize and gain through that. Work on running your business, not the benefit. Whatever's forgiven is great. The financing terms on the rest of it, they're still great as well. So really focus on getting your business back, not trying to overgame the PPP loan proceeds. All right, so on to our COVID-19 financial prescription for businesses. We of course covered a lot of the PPP and the EIDL loans. Other items, if PPP wasn't a fit for you, work with your CPA and see if the payroll tax credit would be a fit. You kind of don't want it to be though. Your revenues are going to have to drop by over 50% by 2019 same quarter. So it's one of those, it's not really a winner if you do get to take this one. You may be able to defer payroll taxes until 2021, 2022. If you have PPP, my understanding on this is you partially until you receive the proceeds can, but pretty much think about it. If you did PPP, this one's not going to apply to you. Also, net operating loss, you are now able to carry them back to 2013, depending on when the loss occurred. So focus on those losses. I'm going to run through some of the bullet points, but I know we're running up almost at a quarter till. So I'll hit the high points. Again, you can go to our website, waddellandassociates.com, and you'll be able to download these in our COVID-19 portal. All right, our financial prescription, I'll move into individuals. What can you do inside your own balance sheet? Great time for Roth conversions is when the traditional IRA account has dipped in value, because the amount that you're taxed on is the amount that you convert over into a Roth. So last year, if the account balance was large and you really weren't eyeing it, you also need to somewhat know what your income will be this year. So keep that in mind as well. You can also double up still on Roth conversions for this year and get them invested into the market while it's at a low watermark, because the deadline for filing your taxes and making your IRA and Roth IRA contributions was extended until July 15th. So you can do your 2019 contribution and your 2020 contribution and get them both invested into the market. And then on getting the rebate, if you did even if you didn't qualify for it, just friends and family that are also trying to figure it out. If it didn't land in your bank within the last week or two, I believe they went out, you're probably going to have to look at what address you used when you last filed. If you filed in a while, maybe your income wasn't near the filing limit. And also, if you electronically filed your last return and then you changed bank accounts, that may be where your problem lies. So definitely pay attention to those details. And on our prescription for taxes, always consult with your CPA and your tax preparer and make sure it's a right fit for you. But a couple things to look to, you can give more to charity right now. They're really in need, and the CARES Act made it a little bit more favorable. Even if you don't itemize, the first 300 of charitable giving is allowed for you. And then also on cash donations, your limitation has been increased on your adjusted gross income. Harvest tax losses and reinvest simultaneously. This is probably a good point and place to bring David Waddell back on to talk a little bit more on the investment opportunity for the second half of this year. So David, I'm going to leave my screen up, but I'm going to bring you back to talk if we can do that.
All right, so I'll wrap up with just a couple of investment points. One, as Teresa so eloquently said, did a great job. Thank you, Teresa. Pull those emergency cash levels back up, figure out what you really need as working capital. And then the most important thing you can do in taxable accounts is harvest your tax losses. If you've got things at a substantial loss, those can be made into tax benefits for you by selling them and reinvesting in something similar. So I would keep your overall investment allocation the same, but do harvest those tax losses and reinvest into something similar. Asset allocation is critical. If you don't have an asset allocation plan, these become really crazy time periods as you're trying to figure out, should I be all in, should I be all out? if you're doing Monte Carlo analysis, probability kind of work, and you work with a wealth strategist or a financial planner, you will have a probability that all your hopes and dreams come true based upon a certain rate of return, and that rate of return is accessible through an asset allocation. So if your asset allocation is 60% stocks, 40% bonds, stick with it. Make observations to ensure that you're at 60-40, because the point of an asset allocation is the opportunity to rebalance when one of the assets underperforms the other. So what we've been doing is making some adjustments within the portfolio, harvesting tax losses, and staying real close to the clients so they maintain their asset allocations. And then finally, I got a call yesterday from somebody who wanted to play the oil market and stuff like that. There are a lot of tempting trades to take right now. If you're an investor, the traders are trying to lure you in so they can feed on you. Don't change your investment personality because of what's going on right now. Now, there are opportunities that you can take, but spread those bets widely, across company size and geographic locations, and just play the game as in or out in terms of your investments as a whole, rather than cherry picking oil, Zoom, who knows. Those are traders' dominion, and you should shy away. So with that, I think, Teresa, is that your final slide? Yes. So you can go to our website, download all these documents. They're there. Brian, if there's anybody still alive on this call at this point, they may have questions. Happy to answer them.
Well, no, yeah, thank you. And I think we're actually there was so much information that I think we're a little short on questions, but if you've got them, you can certainly email Amy Daniels or your chamber representative, and we will get that to Waddell and Associates. I think I want to summarize it. I took away three big things. One, comparison to 1957 versus 1918. I hadn't heard that comparison before. That gives me a whole new insight into trying to forecast my own company and the strategic plans that we're building. Excellent work. Two, Teresa was totally wrong on trusting your gut. Call your experts and trust their gut, Teresa. Don't tell me I was wrong on my thing. All right. Three, if you don't have your notes at the beginning of these, you don't do a great job. And I lost all my notes in the transition. So Amy Daniels, with your chamber, send me some stuff, and I'm going to summarize real quickly so we can move on, because she was yelling at me, which she does. So first, let's say Thursday, we've got a new webinar for you, Taking Care of Your Teammates, with Clark Butcher of Victory Bicycle Studios and Judy Bell of Judy Bell and Consultants. And I personally asked those two. I've seen them do some really cool things to take care of their teammates, and I think that's a valuable thing right now. And Amy also said this, it's 12 p.m. this Thursday. That'll be our rhythm, Tuesdays and Thursdays at 12. But a lot of people that are joining aren't chamber members. So if you're not, hey, like, we need you to join, and we need to thank our sponsors for doing all that. So please do that. But forward all this information out to people that aren't members if you think that they'll get good content about this. I'm seeing some questions about recordings and things like that. We're going to get this recording. The chamber's going to send it out whenever they do that. I'm on the board. I'm a volunteer. I don't know. But know that we've got a great team down there at the chamber. They're going to get this out. But we really want people to be on live to get their questions answered. And again, I think she said you didn't introduce yourself, Brian, at the beginning. I don't have any patience for that. I'm a board member. I'm a small businessman, just trying to make it like you are. I want you to get the content, and I think that David and Teresa crushed that. If you got questions that sorry we didn't have time to get to today, please, send that in. What was that? We'll send that out. We'll ask the chamber to send that out in the next email about how to get questions to David and Teresa, and we'll try to make sure we have a bookend slide to do that at the end for our next people. So look, please join us this Thursday noon for a new webinar. And if you've got a topic that you care about, send it to the chamber. And please stop texting me with your questions. People are actually, David, texting me all their questions right now because the Q&A button is down there. I'll get these to David. Thank you for your time, everyone. Get back to your lives. We went a little bit over today, but I found it to be pretty good stuff. Thank you. Please join us again on Thursday. And thanks to Independent Bank for helping to put all this on. Bye.